I am really honored to introduce the faculty of the first session, CA Saurabh Soparkar sir. સરે મને ઇન્સ્ટ્રક્શન આપ્યા છે કે 10 સેકન્ડમાં ઇન્ટ્રોડક્શન પતાવું, તો હું ખાલી એટલું જ કહી શકીશ સાહેબના વિશે કે ઘરના વડીલ જ્યારે ઘરે આવે તો એમને ઇન્ટ્રોડ્યુસ ના કરવાના હોય. પ્લીઝ હેવ અ રાઉન્ડ ઓફ અપ્લોઝ ફોર સર.
Good morning, friends. મને કહેવામાં આવ્યું કે સંખ્યા થોડી પાકી છે કારણ કે એક કારણ પર્યુષણ પણ છે. મને ખબર હતી પર્યુષણમાં રેસ્ટોરાં ખાલી થઈ જાય છે, પણ લેક્ચર હોલ ખાલી થઈ ગયા છે એવું પહેલી વાર જોયું. એનીવે, I am happy even if there are 5 people around here, because idea is to share knowledge, and therefore irrespective of the number of people I would go in the same way in which I would go. I am required to discuss with you the special provisions for assessment of search cases being introduced by the Finance Number 2 Act 2024, a resurrection or revival of Chapter 14B. Those of us who have been in practice since quite some time would know that we had originally Chapter 14B, which so to say was kept aside. Now again it is being revived. So let us go first of all to historical background of this amendment, or this set of amendments, and then we will see what is it that is sought to be done by these amendments, and how is it that people are likely to be seriously prejudiced on some of the issues. First, to a little historical background. How to frame assessments post-search has always been a tricky issue. At the time of search, revenue finds a lot of data in relation to the current year or years where assessments are pending. But the revenue would also find lot of data of past years, 2 years, 3 year, 4 year, 5 year. So obviously revenue would like to tax income of those years in one or another scheme. Traditionally, if information was made available to the revenue, including by search, that any income has escaped assessment, the case of the SSC would be reopened. But then section 147, 148 mechanism, all of us are aware, is not only time consuming, but also in a given case, it also has serious procedural conditional requirements. And therefore, time and again, methods are being found out as to how revenue would be in a position to deal with search cases. The first attempt was introduction of Chapter 14B. I am not talking about the current chapter, I am talking about the old chapter. Because I would be discussing the current chapter in juxtaposition with the provision of the old chapter, and we will see how the things are fundamentally different or identical. Chapter 14B was originally introduced from 1st July 1995. It said assessment of undisclosed income. Kindly mark the phrase assessment of undisclosed income. I am asking you to mark it because when we go to the current Chapter 14B, we would find a significant shift, a deliberate shift from assessment of undisclosed income to assessment of total income. Now under the new chapter, it is assessment of total income. We'll go there a little later. Originally, it was assessment of undisclosed income. The term undisclosed income was defined. Broadly, it was money, bullion, jewelry, valuable article or thing which have not been or would not be disclosed or any entry as to income, expenditure, etc., which are not known. Question that arose was, what happens if there is a search? Under the then chapter 14b, if there is a search, there will be a block assessment. Block period being defined as 6 years before the year of search, and for the year of search from 1st April till the date of search. Let's say hypothetically, search takes place on 20th of October. I'll take this hypothetical example even a little later. Then from 1st April to 20th of October of the year of search, plus immediately 6 preceding assessment years. What happens to the regular assessments? In as much as this is assessment, or this was assessment of undisclosed income, controversy arose as to whether regular assessment would or would not survive. Would there be 2 parallel assessments, one in relation to regular income, another in relation to undisclosed income, or there would be only one assessment? The language of the section was not very happy. Punjab and Haryana High Court 227 ITR 187 and Kerala High Court 228 ITR 314 took a view that there will be only one assessment and no 2 parallel assessments. When these 2 judgments were cited before Gujarat High Court in the case of NR paper 234 ITR 733, Gujarat High Court did not agree with that view and said no, there will be 2 parallel assessments, regular assessment for regular income, block assessment for undisclosed income. In view of this difference of opinion, legislature stepped in, law was amended, and it was clarified there will be 2 assessments. Gujarat view was accepted. One, regular assessment for regular income, and second, block assessment for the block income or undisclosed income. Why this difference? Regular income will be taxed at regular rate. Block income or undisclosed income would be taxed at 60%. So there was always desire on the part of revenue to put income from regular to block, because then instead of, let's say, 30%, they'll get 60%. And SSC would always try to take the income out of block by saying it is my regular income, put it in regular assessment, because then he would end up saving the taxes. This debate went on, and lot of assessments failed wholly or partly because of the fact that there were always borderline cases, and it was at times very difficult to say whether this is an undisclosed income or a disclosed income. For example, there are entries in the books of account which are found to be incorrect. Now, whether this is undisclosed income or it is a regular income, there are matters of grave debate. So, on 31st May 2013, this chapter is abandoned. It's buried. We have now section 153A to 153C mechanism, with which all of us are reasonably familiar. To recall 153A, 153 said, whenever there is a search, again block of 6 years or 10 years, whenever there is a search, all pending assessments will abate. However, assessments which are already concluded would be assessed or would be reconsidered or reassessed under section 153A insofar as there is an incriminating material. So then, if there is a search, 6 years cases will be taken up for section 153A. Out of those 6 years, firstly, it will be found out where assessments are pending. If assessments are pending, AO would assess whole income under section 153A. Wherever assessments are completed, he was then bound to go only by incriminating material. Revenue claimed that if there is a search, we have a right to look into last 6 years irrespective of incriminating material. But then lead judgment, Delhi High Court, Kabul Chawla, 380 ITR 573 and Gujarat High Court Soumya Construction 387 ITR 529 very clearly held that wherever the assessments would not abate because they are not pending, in other words, wherever assessments are completed, you have right to make any addition under section 153A only if you have incriminating material. This view was carried to Supreme Court, and Supreme Court in the case of Abhisar Bildwell recently, last year, 454 ITR 212 confirmed that view. Now look at the problem of the revenue again. What is incriminating material? Take a simple example. Search takes place, let us say, in the year 2019. Assessment for assessment year 15-16 is already concluded. AO finds in the books of account share capital or loans or certain expenses. At the time of search, he has nothing to indicate that these are not genuine. So there is no incriminating material found at the time of search. But later on he makes inquiries and finds, or maybe in the years where the assessments are pending, he makes inquiries and finds that these are not genuine entries of share capital, loan or expenses. Would he be entitled to touch these items? Now courts have taken a view that only if you have incriminating material in relation to that year, you can touch section 153A. So again, the controversy started, what is incriminating material, what is not an incriminating material, and therefore again revenue started feeling the problem of framing assessments under section 153A. Please mark, sections 153A, 153C did not deal with any higher rate of tax. Whatever was to be taxed, it was to be taxed at regular rate unless section 68, 69 additions are there by virtue of a special provision, it will be taxed at a higher rate. Otherwise, income was to be taxed at a regular rate as opposed to chapter 14B where it was to be taxed at the higher rate. So again, legislature thought it appropriate to drop this. And on and from 31st March 21, sections 153A, 153C were made inoperative. Amendments were made under section 148 automatically, whereby if there is a search, cases of past years will be reopened. They will be reopened and then they would be assessed as regular assessments by way of reassessments. Now again, somebody in North Block must have thought this is not working. So what is being done is, and now I really come to the issue in hand. Chapter 14B, which was buried quite down below in the earth, somebody has revived it. Why do I say revive? Old section 158B, new section 158B, same. Not only that, look at, there is no desire or intention to really apply mind in giving section number. Originally, we had section 158BF and then 158BG. Then section 158BFA was introduced in the year 1997 for levy of interest and penalty. So BF, then BFA and BG. Why BFA? Because it was introduced between BF and BG at a later date. Under the new scheme, they have maintained the name, same section and the same number. So now the new chapter reads section 158BF, BFA and BG. Now I wonder as to why you could not have said BF, BG, BH, BI, but no. Same section as if it is the same thing. But it is not the same chapter. It is a verse of both the chapters. And why do I say it's a verse of both the chapters? And why it is likely to create serious complications. To recollect, under the old chapter 14B, rate of tax was 60%. That rate is maintained. And under the new sections 153A, 153C, there was a concept of abatement of pending assessments and reframing of assessments that is maintained. This is likely to create some problems which we will go as I go forward. So now let's go to the chapter. Section 153B contains two definitions, clause A and clause B. Clause A is the definition of block period. It is almost equivalent to the earlier definition. Block period is period of 6 years immediately preceding the year in which the search takes place, plus the period from 1st April till the date of search in the case of year of search. So in my hypothetical example, if search takes place on 20th of October 24, why do I take that example and not today's date? Because the chapter is going to be applicable from tomorrow. Only if there is a search or requisition on and from 1st September 24, this new chapter will come in. So therefore, let us assume there is a search on 20th of October 24. Then assessment year 2021, 21, 22, 22, 23, 23, 24, 24, 25 or 19, 20. So our last 6 years plus assessment for the period from 1st April 24 to 20th of October 24 would be the block assessment. Two issues. One, under the old block, it was 10 years, it is now 6 years, because legislature has now decided not to go beyond 6 years. But then I have a question. Earlier, you could go for reopening up to 6 years. When new chapter from 1st April 21 reopening was introduced, it was scaled down to 3 years, but in a given case, you can go up to 10 years. By the very Finance Act, this time, that period for reopening is reduced from 10 years to 5 years. Now, if you are reducing from 6 years to 5 years for reopening, why do you keep 6 years over here? Unless you just want to copy paste old chapter, because old chapter said 6 years, here it is 6 years. Without appreciating, under the old chapter, you could reopen up to 6 years. If you recollect section 148, ordinarily 4 years. If there is a failure on the part of SSA to disclose truly and fully all material particulars, proviso to section 147 said 6 years. So because it was 6 years then, old chapter 14B said 6 years. Now section 148 says 5 years, but new chapter says no, 6 years. So this is one. Second, why do you need the whole chapter? Please see the speech of the Honorable Finance Minister contains a statement that we are revamping the whole income tax code, we are bringing the new code. She has also made a statement somewhere else recently that committee is set up for the purpose of drafting the new code. If the new code is being drafted, and probably if she is right, and by the next finance bill or by the next budget, the whole act is going to be scrapped and we are going to have the new act, why do you bring these changes from 1st September 24 to 31st March 24? But that's the wisdom of the government. I'll stop at that. Then comes definition, clause B, of undisclosed income. It is in two parts. First is understandable, money, bullion, jewelry, valuable article or thing. Or second part, any entry in the books of accounts or documents or transactions, books of account, transaction document, where in either case, which represent wholly or partly income or property which has not been or would not be disclosed for the purpose of assessment. We'll go to second part little later. So, if at the time of search, any money, bullion, jewelry, etc. are found, or details of books of account record entry is found, which have not been or would not be. Why would not be? Because if you do not keep that particular phrase, SSE can always say, this is my transaction of the current year, which I would have disclosed. Therefore, don't put me in the block assessment. Or, this is my transaction of the last year, return of income is not due, I would have in my return of income disclosed, and therefore, do not go for the block 60% rate. Now, by virtue of this phrase, if revenue can establish that, look, you would not have disclosed this income because we have reason to believe this is outside your books, you would have maintained outside your books. These are entries, though it may pertain to the current year or it may pertain to the year for which return of income is not due, you would not have disclosed. Again, it would fall in the definition of undisclosed income. This is replication of the earlier definition, therefore there is not much of an issue there. The second part, which I am now saying, is part replication and part addition. What is the second part? Or any expense, exemption, deduction or allowance claimed under the Act which is found to be incorrect in respect of the block period. So if revenue finds that an SSC has claimed expense, exemption, deduction or allowance incorrectly, it would result into addition under the block and subjected to undisclosed income. This is one clause which is likely to create lot of disputes and lot of heartburning. I only indicate this wise what is a change. Earlier the phrase exemption was missing. Under the earlier scheme, if there is an exemption wrongly claimed, it was not an undisclosed income. And second, earlier the phrase was found to be false. By merely changing the word false to incorrect, there is going to be a sea change. There is going to be significant problem to the SSCs. When we go to the computation of block income, we will elaborate on this issue. For the time being, just park this issue that any claim of expenditure, expense, deduction or allowance which is found to be incorrect becomes an undisclosed income. That takes me to section 158BC. Under section 158BC, sorry, 158BC, undisclosed income will have to be assessed in the hand of the person who is subjected to search. This income is as opposed to earlier chapter assessment of undisclosed income. Now it is assessment of total income. Earlier, undisclosed income was subjected to tax at 60% because regular income was being taxed regularly. Now, total income is to be taxed at 60% because there is no assessment of regular income. So what could be a regular income would now be subjected to tax at a higher rate. When we go to the components, we will see this. So now what is the mechanism? Step number 1. If any assessment is pending, that pending assessment on the date of search shall automatically abate. This is the concept borrowed from section 153A. This was not a concept under the old scheme. Now the new scheme says, let's say search takes place on 20th of October. Now assessments are to be framed within 12 months from the end of the relevant assessment year. So ordinarily, assessments for the period up to assessment year 22-23 would have been finished. Assessment for 23-24 would be pending. Or if there are updated returns for some earlier assessment years which are still not assessed, they may be pending. All those assessments will be dropped. So no assessments in relation to those returns. If there are TP references made, those TP references will also abate, no further reference. Exception is that if there is search assessments are going on under this chapter, let's say 20th October search takes place, block assessment starts somewhere in 2025-26, and SSC is so smart, and SSC again is search in 2026. So first block is still being assessed and second block starts. Then the law says that in such a situation, the first block will not abate. Once that is over, second block assessment will start. If assessments are annulled, but later on that annulment is set aside, those annulled assessment will revive. so that revenue is not left high and dry. Total income of the year of search, April 24 to 20th October 24, except undisclosed income will be assessed separately. And total income of the block will be taxed at 60%. This is broadly the scenario. How does it operate? Let's go to section 158BB. Under section 158BB, there is the computation mechanism, and it is here that we need to discuss slightly in greater detail. Under section 158BB, 5 sets of income will be taxed, or will be first of all totaled up. No, tax is the wrong statement. Totaled up. 5 sets of income. Number 1, whenever there is a search, SSC will be called upon to file the block return. So the first would be income returned by the SSC in his block return. Let us say SSC says, I have undisclosed income of rupees 2 crore. So first component is rupees 2 crore. Second, income already assessed to tax under section 143.3, 144, 147, 153A or 153C in any of the earlier 6 years. So hypothetically, let's say for assessment in 1920 and assessment at 21-22, SSC had filed returns of income and assessments are already framed. The second addition would be, let's say income in the respective year was rupees 1 crore each. So 2 crore plus 1 crore, 2 more crore. Third component, total income declared in the return of income filed under section 139 or in response to notice under section 142 or in response to section 148. So second component deals with the assessed income. Third component deals with returned income which is not assessed. So let me again take an example for AY 2021, 22-23 and 23-24 SSC has filed returns of income, but they are not assessed. 143.1 is issued. Let us again take hypothetically rupees 1 crore each, so further 3 crore will be added. So 2 crore plus 2 crore plus 3 crore. The fourth component, total income determined where previous year has not ended. So from 1st April 24 to 20th of October 24, income determined for this period on the basis of entries in the books of account or other documents maintained in the normal course of business on or before the date of last authorization for search. So this is, if I can use the phrase, regular income as opposed to undisclosed income. So for this broken period, April 24 to 20th October 24, what is the income which is disclosed in the books of account on the basis of his entries, on the basis of record? In other words, what is it that SSC would have on his own disclosed it if there was no search and by the end of the year accounts are made up and return is filed? When we go to exclusion, I will have to say something on this. For the timing, I am just saying fourth item. Now the fifth item, and this is the issue. Undisclosed income determined by the assessing officer under section 158 BB subsection 2. When we go to subsection 2, it says assessing officer shall determine undisclosed income on the basis of 3 things. 1, evidence found during the course of search. Second, such other information and material as are available with the assessing officer. And third, any information which comes to his notice during the course of assessment proceedings under this chapter. So now let me tie up. We are dealing with 5 items. I am now on the 5th item. Assessing officer shall find out what is undisclosed income on the basis of A, search material, B, whatever information may come in his possession, and C, on the basis of further material that he may come across. Take a case for assessment year 21-22. Assessment is framed, rupees 1 crore. No incriminating material is found. Assessing officer, now if there is no incriminating material found, under the old block, AO could not have touched it, because old block said undisclosed income only of, assessment only of undisclosed income. Under the mechanism of section 153A, AO could not have touched it, because 153A said only if there is an incriminating material, you make addition. Now the section reads, assessing officer shall have to find out what is undisclosed income. And what is an undisclosed income is, please go back to what I started a little while ago. Any expense, exemption, deduction, or allowance claimed under the Act which is found to be incorrect. So assessment at 21-22, SSC had claimed expense of rupees 20 lakh. They were granted. Now AO comes to a conclusion that it is wrongly granted. Why? Because of some technical reason, not that its entry is false. Or SSC had claimed an exemption, and AO finds that no, that exemption is not admissible to SSC for whatever reason. SSC had claimed some benefit. At the relevant time that benefit was granted, now AO takes a second look at the matter, not on the basis of search material, but because he is required to reframe the assessment, he takes the second look. That will be undisclosed income. So either to what was false was only coming within the definition of undisclosed income. Now whatever is incorrect would also come within the definition of undisclosed income. Hitherto what was only concealed from the revenue, incriminating material found at the time of search, which would give rise to addition. Now incriminating material is irrelevant. That's obviously available to him, but independent of incriminating material, if he comes to conclusion that there is an undisclosed income in the wider sense, not undisclosed income in the sense it is not disclosed, but undisclosed income in the sense that an impermissible claim of expenditure, impermissible claim of allowance, deduction, whatever. It will all fall in the definition of undisclosed income. Consequence is, it will be taxed at 60%. Now, if assessment at 21-22, I make a claim, it was not allowed, I would have carried an appeal, I would have lost, I would have paid tax at 30%. Why should I be called upon to pay tax at 60%? Because assessing officer now takes a different view. If the case would have been reopened, probably I would have argued that reopening is not permissible because the issue was gone into, there is no fault on the part of SSC. Or I would have argued, if the period of 3 years are over in the new scheme, no asset, no expenditure, no entry. All these things have gone away now. AO will frame fresh assessments for 6 years and the truncated period. At the time of fresh assessment, whatever he finds is not allowable, he'll make an addition. And all that is added would be subject to tax at 60%. So he will add these 5 items, and then it's not as if the total will be taxed at 60%. Why total will not be taxed? Because whatever is disclosed, whatever is assessed, has already gone taxed at the appropriate rate. So from that, what he will take out is 3 items. 1, assessed income. 2, wherever return is filed, the income returned. And 3rd, for the truncated period, whatever is tax income in relation to truncated period. What would remain therefore would be item 1 and item 5, namely undisclosed income declared by the SSC and undisclosed income assessed by the SSC, assessing officer. So an undisclosed income assessed by the assessing officer would be in relation to all the 6 years plus the broken period and on the basis of this wider definition. So this is one fundamental change under the scheme of the Act, whereby the scope, the spectrum of undisclosed income has gone significantly to a greater extent, and apart from the spectrum going up, the rate of tax has jumped from 30% to 60%. There is one lacuna which I had indicated at the time of my budget speech. What happens to the return for the year which I have not filed because return of income is not due at all? Please mark, I started by saying assessments framed. Then I said returns of income filed, assessments not made. And then I said return of income for the current year truncated period. But then there is in between assessment year 24-25, of which return of income, let's say audit case, is not due on 28th of October 24. That item is erroneously missed out at both the stages. Where would that go? If you take a view, therefore that will have to be dropped. Then the problem is, whatever is the income of the current year, AY 24-25 will be taxed at 60%. So obviously it cannot be dropped. I can't put it in the last clause because the last clause, clause number 4 says, return of the income for the year of the search. This is not the income of the year of search, it's income of the year preceding the year of search. So what happens to that? Scheme nowhere addresses this. This is one lacuna that they will have to address. This is one major problem. Second major problem, the carry forward losses will be ignored and the losses of the current year of the 6 years will be ignored. So what happens is this. Take a situation. The block in the present case will start from AY 2019-20, 19-20, 20-21, 21-22, 22-23, 23-24, 24-25, and then the broken period, 19-20. Suppose I had loss in assessment year 18-19 of rupees 3 crore. I would have carried over. I would have claimed set off in the years to come. I would not have been required to pay any tax and I would not have paid any tax. Now section says that loss will be ignored, which means for assessment in 19-20 rupees 2 crore, 20-21, 21-22, that 3 crore of rupees loss which I set off and therefore to that extent reduce the income, that income will revive. And once income revives, it will be taxed at 60%. So by ignoring the loss of the earlier year or earlier period, I end up paying tax at 60% for the block period. Even within the block, let's say AY 21-22 had a loss of rupees 2 crore. 22-23 had an income of rupees 3 crore. I set off loss of rupees 2 crore against the income of 3 crore, had an income of rupees 1 crore. Now 2 crore would go away. So my income will be 3 crore. My returned income is 1 crore because I had claimed the set off. Now income will be assessed at 3 crore, meaning thereby rupees 2 crore will be subject to tax at 60%. Now, there is no logic as to why loss would go away. Unless you make a provision, if loss goes away, what will be assessed will be at the regular rate. But no, you are not providing for regular rate. Therefore, apart from the fact that now scope of undisclosed income has gone up significantly because there could always be items which will be subject matter of debate as to whether it's allowable or not allowable. And therefore, what is held by AO not to be allowable will be taxed at 60% without there being any incriminating material. Now even loss will go away. From the language of the section, it appears loss will not go away permanently. It will skip the 6 years. It will be available to in the 7th year. But then it doesn't say notwithstanding anything contained in any other provision. Therefore, the life of loss being 8 years, do I end up losing 6 years in between? That's also an area which will have some debate in the years to come. I now go to the next issue, procedure, 158BC. Once assessing officer finds an assessee search, notice will be issued for the purpose of filing return of income, including of undisclosed income, within 60 days from the receipt of the notice. Now this is important. If return of income is filed within 60 days, it is fine. But if no return of income is filed within 60 days, then there will be no extension and assessing officer will presume there is no return of income at all. If there is no return of income, there are consequences which will go little later. So 60 days you file return of income. People might think, let's be smart, on the 59th day I'll just file return of income declaring 0 rupees and then I will revise after some time. That is also not permissible. Return of income will not be permitted to be revised. So within 60 days you will have to make up your mind what is your undisclosed income that you want to offer. At times you do not get even the search material within 60 days. How would you make up your mind? But that's your problem. You must make up your mind as to what is the returned income, what is the income that you want to return. Within 60 days you return it. Otherwise you miss the bus of filing a return of income. The price of missing that bus is very heavy, which we'll see little later. This return will not be subjected to section 143(1) at all and will be processed subject to prior approval by ICAI, EDIT. That's a small issue. Section 158BD, like our section 153C. Under the old scheme, if at the premises of the search person, any money, bullion, jewelry, valuable article or thing, or books of account, documents or material of third party were found, the scheme was the AO of the search person will hand over material to AO of the third party and AO of the third party will then start proceedings. Something analogous to 153C. Now there are two important changes and the second change is far more important. Under the old 158BD, if any money, bullion, jewelry, valuable article or thing belonging to third party, you could go under 158BD. The same phrase was used under 153C. Argument was canvassed before the High Courts, lead judgment being Vijay Chandrani, that the word belonging to is not pertaining to. And therefore, let's say in the books of account of the search person, there is some information pertaining to a third party. It's not belonging to third party, it only pertains to third party. You can't go for 153C. They amended 153C, so now new 158BD uses the amended language. So money, bullion, jewelry or books of account, document or material belonging to or pertaining to third party are found, the AO of the third party will have to start assessment. But the second change is little more interesting. Under old 158BD or 153C, the provision is books of account, other documents, assets seized or requisition belonging to third party are found, the materials go to the AO of the third party. Now, not only books of account belonging to third party, it also says books of accounts or information contained therein belongs to third party. So books of account may only be of the search party. Nothing other than books of account of the search party are found. But in those books of account or in those documents or material, information pertaining to a third party is found, then third party will be hit. So a person A is searched. In his books of account, let us say it is found that he has received share capital rupees 20 lakh from Mr. X. AO believes that this share capital may not be genuine. So AO of A has information in the books of A that X has given share capital. So then that information will be passed on to the AO of X. And 158BD against X for all 6 years will start. Please see, under old 158BD, it was for undisclosed income only. So X could have probably got away by saying whether this 20 lakh is genuine or not, I answer this. Now X has to answer undisclosed income of, not only undisclosed, total income of 6 years. So A's AO believes from the books information I have is of X. So X automatically gets notice for 6 years plus the broken period. What happens if ultimately it is found his capital is genuine? Would he be entitled to say, now that the capital is genuine, the very purpose, very basis for starting proceeding against me fails? Probably yes, because if you recollect, Juneja's judgment of our High Court saying that if you start 148 recording reason A, you can go to reason B, C, D in assessment, but if reason A itself has gone away, you can't make addition under B, C, D. Or this is a condition precedent that information must be available which is incriminating of the third party. So if that information itself is incorrect, you have wrongly gone to third party. But these are issues which are going to arise. Because Mr. A is searched, people who are associated with A, rightly or wrongly, in accounted business or unaccounted business, or people who are perceived to be associated with A, they may not actually be associated with A, they are all likely to face the music, because now the scope of section 158 BD is quite wide, and AO of the search party can just pick up information and send it to the AO of the third party. So this is how 158 BC and BD are going to operate. There is some controversy now under 153A versus 153C, whether the period of 6 years would be the same or different, because 153C will start at a much later date. Here also 158 BD will start at a much later date, but they have made it very clear that it will be the same period. So suppose search takes place on 20th October 24, the block period is assessment in 1920 plus period up to 20th October 24 for A. It will be the same period for B, even if his proceedings start after 3 years. When do you complete assessment? 158 BE. Earlier, section 158 BE said 1 year, then in the year 1997, they extended to 2 years. Now, new section 158 BE says 1 year only. So, within 1 year from the end of the month in which notice under section 158 BC is issued, you have to frame assessment. You get 12 more months if it's a transfer pricing assessment. Similarly, section 158 BD, you get 12 months from the end of the month in which notice under section 158 BC read with 158 BD is issued, subject to extension of 12 months in case of TP assessment. There will be no interest under section 234A, B or C under section 158 BF. Now I go to 158 BFA, interest and penalty. And this is slightly important, so I'll spend about 5-10 minutes on this. There is no interest under section 234A, B, C, but there is one interest. If you are issued notice under section 153C to file return of income and you do not file within time, then you are liable to pay interest at 1.5% per month from the date on which you were required to file return of income till the date of assessment. Now please mark, this is quite different from the earlier provision where it said from the date on which you were to file return of income till the date you actually file return of income. Because let us say I was required to file return of income by 31st March 25. I filed it on 5th April 25, declaring income of rupees 5 crore, paying tax of rupees 3 crore. Even though I paid tax of rupees 3 crore on the disclosed income of 5 crore, because I have filed return of income belatedly, it will be ignored. And let us say assessment is framed on 31st January 26. It has to be within 12 months. Then I am required to pay interest on rupees 3 crore right up to 31st January 26. So and that's why please recall I said you must file return of income within the prescribed period, otherwise there are consequences. This is first consequence. Namely, you are liable to pay interest for the period, including the period for which assessment is framed. There is an interesting provision of section 158 BFA subsection 2, penalty. Number one, to begin with, it is open to assessing officer to levy penalty if he finds there is not full disclosure. So penalty would be at 50%. Under the old scheme, it was 100 to 300%. Now it is 50%. Effectively 60% rate of tax, 30% penalty, 90%. There is one interesting exception. If you satisfy 4 conditions, to the extent you satisfy 4 conditions, there is no penalty. What are the 4 conditions? 1, in your return of income, disclosed undisclosed income. Therefore, let us say I filed return of income disclosing rupees 2 crore as undisclosed income. Condition number 1. 2, I have paid taxes on or before filing of return of income, or if department has already attached my bank account or money, I have authorized department to appropriate from the attached asset the amount of taxes. In other words, I have paid on rupees 2 crore, tax of rupees 1.20 crore, or authorized department to recover rupees 1.20 crore from my savings account or current account, whatever is attached. 3, I have attached to my return of income proof of payment. Now look, somebody who is copy pasting does not know that attachment of proof of taxes may be relevant in the year 1995 where everything was not computerized. Now whether or not you paid taxes, you go to portal and you find out. Why do you need receipt of payment of taxes to be attached? But because it was there earlier, again it is there. But the 4th, no appeal is filed against the order of assessment to the extent of your returned income. This is a positive thing. So take as example of rupees 2 crore, I filed return of income of rupees 2 crore, I pay tax of rupees 1.20 crore, I attach proof of payment, ultimately assessment is made at rupees 10 crore. There are further addition of rupees 8 crore, right or wrong. I have a right to challenge the addition of rupees 8 crore. I have to be extra careful to see that I challenge only up to rupees 8 crore. If I challenge beyond 8 crore and thereby challenge my own returned income, I get no benefit. But if I challenge only the difference or amount added, or to put it differently, I do not challenge what I have returned and is assessed. To the extent of rupees 2 crore, I don't suffer penalty. So once I come clean, let's put it this way, once I come clean and offer income at the end of search, at the first instance, I am through. Now here again there is an interesting twist. Under the old scheme, what was not subjected to penalty was equivalent to 271(1)(c). Now what is not subjected to penalty is this 158 BFA 50%. But they have also said penalty will not be levied under 4 more sections. 4 other sections are 271 AAD. 271 AAD is the penalty for falsity in the books of account or entries in the books of account. I understand. Now, issue. It is found that I have got false entries in the books of account worth rupees 10 crore, of which I have made disclosure of rupees 2 crore. Which disclosure is never disputed by me, I satisfy all conditions. The result is no penalty under section 271 AAD, including for rupees 8 crore. 8 crore which I have not disclosed and for which I get otherwise no immunity, as per the language of the section, 271 AAD itself will not apply. Now this is still a matter of some debate, but 3 other penalties which are not to be levied are 271D, 271DA and 271E for the breach of section 269SS, 269ST and section 269T. Now what have these penalties to do with quantum? Suppose a person has got rupees 10 crore cash loan and 10 crore cash repayment of loan. But he is able to show from where he has got the money, to whom he has repaid the money, so section 68 is not likely to be applied. He would rather wish there is a search, so that if there is a search, he can make disclosure of undisclosed income of 5 lakh, 10 lakh, 15 lakh. There may be no other addition, but the moment he pays tax on rupees 10 lakh, which is undisclosed income, on which there is maybe an assessment, he gets immunity under section 271D, 271DA and 271E. I am not sure what is the logic. Maybe they have not really applied their mind, but it is to the benefit of SSC, therefore I am not raising quarrel. I am only pointing out that if your returned income you are not disputing and paying taxes, these 4 sections will automatically go out. One more positive thing which was there earlier also, penalty proceedings will not start till the matter is concluded at the CIT appeal level, or if you take it to tribunal, till the tribunal level. So for 3-4 years at least, penalty proceedings will not start. So it's only after the tribunal settles the amount of tax payable by you, question of levy of penalty under section 158 BFA will start. The assessment will be framed by a person not below assistant commissioner, will have to be approved by a person of additional commissioner, joint commissioner, etc. This is the procedural issue. So then this completes the discussion. What is the summary? Summary is this, as I said at the beginning, is combination of both earlier schemes, block and 153AC, whereby they have tried to bring in wherever revenue had problem, they have tried to resolve by making this provision. In the process, they have probably gone far beyond what was expected, which is likely to put SSS to a lot of inconvenience. And more ironical situation would be probably by the time this chapter is actually put into practice, because let's say there is a search on 20th of October 24, sorry, I forgot to mention, assessing officer, the period of 12 months of framing assessment will start after AO will get record from the search party. And they have been given time up to 680 days for transmitting the record. Therefore, let's say search takes place on 20th of October. 3, 4, 5 months will take place for the transmitting record, which is now not a problem because you are given 80 days officially. Then notice under section 158 BC will be issued. We would have crossed 1st April 25. By this time, the whole section may not be applicable, at least from next year onwards. So we are looking at this section to operate from 1st September 24 to 31st March 25, or the Honorable Finance Minister is not serious about the new tax code, or let's give her credit, in the new tax code, identical provision is going to be repeated. Only then this will make sense. Otherwise, we are all having this academic exercise, which is likely to be of a very small window. With this, let me thank you all for a very patient hearing.
Thank you, sir. In a really excitement to listen to you, we forgot one formality. I request Chintan Bhai Patel, our RCM, to do the honor to present a memento to sir. Yeah. Thank you, sir. On behalf of Ahmedabad branch of WIRC of ICAI, I propose a hearty vote of thanks and enlightening us how the computation will be, how loss will be treated, and how the third party will get affected, and more importantly, the penalty provision and all the things. And as you rightly pointed out, recently they have announced that within 6 months they are coming up with the new code. So again, we are sure that we will be inviting you to, for the same also, to listen on this topic again. Thank you very much. Thank you, audience, for your patient hearing. Thank you once again.